All right, so a new AI company is about to hit the stock market. And, whenever that happens, investors get really excited. But with all that high potential comes some pretty high risk. Today, we're going to break down the initial public offering, that's the IPO, for Toku Ltd, a Singapore-based tech firm that's been making some serious waves in customer experience. So let's dive in and see what's really going on under the hood.
And that really is the big question, isn't it? As Toku gets ready for its big debut on the Singapore exchange, are you looking at a huge growth opportunity, or is this a gamble that comes with some major red flags? We're going to dig into their official documents to figure that out.
So, first things first, what does Toku actually do? Well, in simple terms, they're a one-stop shop for big companies to handle all their customer conversations. Calls, chats, emails, the whole shebang. Their secret sauce, really, is using AI to tackle the unique headaches of the Asia-Pacific market, like dealing with a ton of different languages, complex regulations, and all sorts of infrastructure challenges.
And here's a peek at their platform. You can think of this as the main control center, their 360-degree customer experience or CX platform that pulls everything together. It's built to give businesses one single dashboard to manage it all. Okay, now that we have a better feel for what they do, let's get into the good stuff, the case for investing.
Every exciting IPO has a powerful bull case, and Toku's built on some really impressive numbers. This is the optimistic story, right? The one that's all about rapid growth and a massive market opportunity just waiting to be captured.
Let's just start with this number, 47.4%. That's Toku's revenue growth from fiscal year 2022 to 2024. Growing by nearly 50% in just 2 years? Wow. That is a huge signal that the market really wants what they're selling. It shows they're not just selling, they're selling fast.
Now, this is where things get really interesting. Their net revenue retention, or NRR, is over 150%. For anyone who doesn't know, this is an absolutely critical metric for a subscription company. It means they're not only keeping their customers, but those same customers are spending 50% more with them every single year. That is just fantastic for long-term, sustainable growth. And this number? This gives us a little peek into their future. We're talking over $23 million in their current order book. This is all contracted future revenue, which should give investors some confidence that the crazy growth we just saw isn't a one-time thing. A lot of it is already locked in.
So how are they planning to keep this incredible momentum going? Well, this slide lays out their 5-part strategy. They want to completely own the complex markets with their AI, boost their profits, grow through partners, expand beyond Asia into new territories, and maybe even buy up some other companies. It's definitely ambitious, but it's a very clear roadmap.
Okay, so that was the bull case, and you have to admit it's pretty compelling. But a smart investor always looks at the other side of the coin. So now, let's flip over to the bear case and get a more complete and, frankly, more cautious picture of what's going on. Now look, this isn't some analyst's opinion. This is a direct quote from the front page of Toku's own official IPO document. When a company says this bluntly, that they're losing money and burning through cash, you absolutely have to sit up and pay very close attention.
And here's what that warning looks like on a chart. Even as their revenue has been climbing, so have their losses. They've gone from losing almost $4 million in 2022 to over $5 million in 2024. For any investor, this is that classic tech dilemma. Do you bet on massive profits way down the road, even if the losses are getting bigger right now?
And beyond those losses, the official documents detail a bunch of other big risks. They're heavily reliant on the Asia-Pacific region, which makes them vulnerable to any kind of instability there. Their huge bet on AI might not pay off the way they hope. And they're facing a minefield of different regulations, really tough competition, and the real possibility that they'll need to raise even more money just to keep growing.
So we've seen the thrilling growth story on one side and the sobering list of risks on the other. What's the bottom line here? How should you, as a potential investor, even begin to process these two completely conflicting stories? It really all boils down to this dilemma right here. The bull case is all about believing in that growth story. You've got amazing revenue, super sticky customers, and a smart strategy. The bear case, though, is about the financial reality. The company isn't profitable, it's burning through cash, and its success is mostly tied to just one region. The decision to invest really just hangs on which side of this scale you think is going to win out in the long run.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.